In today's video, we're taking a deep dive into a popular investment vehicle, index funds. We'll be covering what they are, providing examples, and discussing the different types. So, what is an index fund? At its core, an index fund is a type of mutual fund or exchange-traded fund, ETF, with a portfolio constructed to match or track a specific market index. By mirroring the performance of a particular index, these funds offer a low-cost way to invest in a large portion of the market. Index funds offer a low-cost way to invest in a large portion of the market, but which ones should you keep an eye on? One of the most well-known index funds out there is the Vanguard 500 Index Fund. As the name suggests, this fund mirrors the performance of the S&P 500 index, which includes 500 of the largest U.S. companies. If you're looking to get exposure to these big players, this might be an excellent choice. Moving on, we have the Fidelity Zero Total Market Index Fund. This fund aims to achieve the performance of the total U.S. stock market, providing broad exposure across all sectors. With no minimum investment and zero expenses, it's an attractive option for budget-conscious investors. Next up is the Schwab International Index Fund. If you're seeking exposure to companies outside the U.S., this fund, which tracks the performance of over 20 developed countries, could be a great choice. It's a straightforward way to diversify your portfolio internationally. The iShares Russell 2000 ETF is an example of an index fund that targets small-cap stocks. If you want exposure to smaller, potentially high-growth companies, this fund that tracks the Russell 2000 index could be a good fit. Finally, for investors interested in income, the SPDR/S&P Dividend ETF might be of interest. This fund targets companies within the S&P 1500 that have consistently increased their dividends for at least 20 years. Did you know there are several different types of index funds? That's what we're about to explore. Let's start with equity index funds. These funds track indices that focus on stocks, whether they're from large-cap, mid-cap, or small-cap companies. You've likely heard of some popular equity indices such as the S&P 500, NASDAQ, or the Dow Jones Industrial Average. Equity index funds can offer a wide exposure to these various sectors of the stock market. Another type of index fund focuses on the bond market. Bond index funds aim to replicate the performance of a specific bond index. These funds can cover government bonds, corporate bonds, or a mix of both. They can provide steady income and are typically less risky than equity funds, making them a common choice for conservative investors. Let's talk about sector index funds. These focus on specific sectors or industries like technology, healthcare, or energy. If you believe in the potential of a particular industry, a sector index fund can provide targeted exposure to that area. Commodity index funds are a different beast altogether. They aim to track the performance of a basket of commodities like gold, oil, or agricultural products. If you're looking to hedge against inflation or want exposure to the commodity markets, these funds might pique your interest. Last, but not least, we have international index funds. These funds seek to mirror the performance of foreign markets. They can be global, focusing on the entire world outside of the US, or they can target specific regions or countries. But how index funds became such a popular investment vehicle and what makes them so appealing to both seasoned and novice investors? One of the most appealing factors of index funds is diversification. By mirroring a market index, you get exposure to a broad array of securities in one go. This spreads the risk across many stocks or bonds, reducing the potential negative impact if one of them doesn't perform well. Another major draw is the cost efficiency of index funds. Because they simply follow an index, they are passively managed. This passive management results in lower transaction costs and management fees compared to actively managed funds. This means more of your money stays invested and compounds over time. The ease of investing in index funds is another big selling point. Many have low or no minimum investment requirements, making them accessible to almost everyone. Plus, with the advent of robo-advisors and online brokerage platforms, buying shares in an index fund is now easier than ever. Surprisingly, one of the biggest appeals of index funds is their performance. While they aim for market-matching returns, not market-beating, statistics show that over the long term, most actively managed funds struggle to outperform their benchmark indexes. Therefore, Investing in an index fund often leads to solid returns over time. Lastly, transparency is a key feature of index funds. You always know exactly what's in your fund because it's replicating a public market index. This transparency allows you to clearly see where your money is going and how it's performing. As with all investments, index funds also come with risks and considerations. Today, we'll be addressing those, so you can make an even more informed investment decision. First off, one of the risks associated with index funds is the lack of flexibility. Index funds are designed to track a specific index, which means the fund manager can't adapt the portfolio based on market conditions. This lack of flexibility can be a disadvantage in volatile markets where active management might outperform. Another thing to consider is market cap weighting. Many index funds are weighted based on the market capitalization of the companies in the index. This means larger companies have a bigger impact on the fund's performance. If these larger companies perform poorly, it can negatively affect your investment. With index funds, investors also give up control over their holdings. Unlike individual stocks where you can choose which companies you invest in, with index funds, you're investing in the good and the bad of an index. This lack of control can be a deterrent for some investors. Index funds are designed to match the market, not beat it. So, while you're likely to avoid dramatically underperforming the market, you're also not going to significantly outperform it. This limited upside potential is something to consider, particularly for those seeking higher returns. Lastly, it's important to note that not all index funds are low cost. While they're typically cheaper than actively managed funds, the fees can vary significantly. It's crucial to check the expense ratio before investing, as high fees can eat into your returns over time. What are the differences between index funds and exchange-traded funds, or ETFs? One key difference between these two types of funds is how they are traded. ETFs are traded throughout the day on the stock market, just like individual stocks. Their price fluctuates throughout the trading day. On the other hand, index funds are traded only once at the end of the trading day, at the net asset value price. Next up is the minimum investment required. Some index funds require a minimum investment, which might be a barrier for some investors. ETFs, however, can be bought for the price of one share, making them more accessible to a broader range of investors. Now, let's talk about costs. Both index funds and ETFs tend to have lower expense ratios compared to actively managed funds. However, ETFs often edge out in this area with even lower costs. But remember, it's important to check as there can be exceptions. Another crucial distinction lies in tax efficiency. ETFs are generally more tax efficient due to the in-kind process they use to create and redeem shares. This structure helps limit the capital gains distributions that investors must pay taxes on. However, it's always important to consider your own tax situation and possibly consult with a tax advisor. Finally, let's talk about dividends. Both index funds and ETFs pay out dividends to their shareholders. However, index funds typically reinvest these immediately, while ETFs accumulate dividends and pay them out to shareholders on a quarterly basis. And there we have it, a comprehensive look at index funds, what they are, examples, and the various types available to investors. Remember, everyone's financial journey is unique, so make sure to conduct your own research or consult a professional advisor before making any investment decisions. If you found this video helpful, don't forget to give it a thumbs up and subscribe for more financial insights. Until next time, happy investing!